Pull up the same stock on 5 different time frames. You'll see 5 different stories. The weekly looks calm, the daily looks broken, the 15-minute looks like a rocket. All of them are true at the same time. Today we'll learn how to read a stock across time frames, and why the chart you're staring at is only one slice of the picture. A single time frame gives you a single point of view. On the daily, a stock can be in a clean downtrend. On the weekly, that same stock can be making higher highs. Both charts are real, both are pricing the same stock at the same moment. But the picture they paint contradicts itself. If you only look at one, you miss the context the others are giving you for free. Rule of thumb: if a setup only works on one time frame, it isn't a setup, it's a coincidence. There are 5 time frames worth tracking. The weekly, each bar is 1 week. This is the long-term tide direction over months and quarters. The daily, each bar is 1 trading session. This is the swing level trend direction over weeks. The 4-hour, 6 bars per session. This is the structure inside the swing, pullbacks, retests, and continuation. The 1 hour, the intraday rhythm where the day's range is being built. The 15-minute, the execution view where exact entries and exits live. Think of it like a zoom lens. Weekly is the satellite, 15-minute is the street corner. Each one tells you something the others can't. You don't pick ones, you read them in order. Here's the discipline that makes it work. The higher time frame sets the bias. The lower time frame sets the entry. Never reverse those 2 roles. Bias means direction, up, down, or sideways. You read it from the weekly and the daily. Entry means timing, the exact bar you act on. You read it from the 1 hour and the 15-minute. Example: weekly trend is up. Daily is pulling back into the 21 EMA, the mean. You drop to the 15-minute and wait for a reversal bar off that level. That's your entry trigger. The higher time frame gives you the wind at your back. The lower time frame gives you a precise place to step in. Either one alone is a guess, together they're a plan. When multiple time frames agree, that's confluence. And confluence compounds signal strength. 1 time frame pointing up, that's a chart. 3 time frames pointing up, that's a setup. Real example: Apple mid-2024. On the weekly, the stock had broken out of a multi-month base. The long-term tide had turned up. On the daily, price was holding above the 21 EMA on every pullback. The swing structure was intact. On the 1 hour, each session was opening above the prior day's close and trending into the afternoon. Weekly bias up, daily structure intact, intraday rhythm constructive, 3 time frames agreeing. 3 time frames agree, that's where the edge lies. Different readers focus on different time frames based on cadence, not personality. If you check the market once a week, you mostly read the weekly and the daily. If you check it every evening, you mostly read the daily and the 4-hour. If you sit with the market intraday, you mostly read the 1 hour and the 15-minute. Same stock, same chart data, 3 different reads because the cadence is different. None of them is better than the others, they're answering different questions. Pick the cadence that fits your week, the time frames follow from there. Sometimes the time frames disagree, and they will. When that happens, the higher time frame wins. Because the bigger trend has more capital, more time, and more participants behind it. When the lower time frame is fighting the higher one, the lower time frame is telling you something useful. Wait. Wait for the lower time frame to come back into alignment. Don't force the trade against the tide. The patience to wait for alignment is itself an edge. Bringing it all together. 1 time frame is 1 slice, 5 time frames is the picture. Higher time frame sets the bias. Lower time frame sets the entry, don't reverse the roles. When weekly, daily, and intraday agree, the setup is stronger than any single chart can show. ArcAlpha scans every stock across all 5 time frames at once, weekly down to 15-minute. Multi-timeframe agreement is one of the inputs the platform weighs into the setup strength score on every chart. This is algorithmic analysis for educational purposes, not a recommendation to buy or sell any security.